Imagine an investment strategy that has beaten almost every professional money manager for the last 50 years. Now imagine it takes about 15 minutes a year to manage. No charts. No research. No checking prices. No stress. This isn't a get-rich-quick scheme. There aren't any. This is the get-rich-slowly recipe, the one Warren Buffett told his own wife to use after he's gone. It's called an index fund. And by the end of this video, you'll understand exactly what it is, why it works, and how to pick one, without needing to know a single stock chart. Welcome back to Cashflow Kitchen. So far we've cooked up the budget, the emergency fund, and the Roth IRA. Today we're cooking what actually goes inside that Roth, the ingredient most beginners are missing. Here's what's on the menu. First, what an index fund actually is, in a way that finally makes sense. Second, why this boring strategy quietly beats almost every fancy alternative. Third, how to pick one without falling into analysis paralysis. Fourth, the difference between a few similar-sounding products that confuses every beginner. And at the end, the costly habit that even smart investors fall into, that quietly erases years of returns. Picture this. Instead of trying to pick which restaurant in your city will succeed this year, you just buy a tiny slice of every single restaurant. All of them. The good ones and the bad ones. If a few restaurants fail, you barely feel it. If a few become huge hits, you ride along. On average, you end up doing about as well as the whole restaurant industry is doing. That's an index fund. But instead of restaurants, it's companies. A total stock market index fund, for example, owns a tiny piece of essentially every publicly traded company in a country. A few hundred to a few thousand companies, all at once. For one purchase. You're not betting on the next big winner. You're betting that, across thousands of companies, over decades, the overall economy grows. Which historically, it has. That's the entire concept. You're done with the hardest part. Now, here's the part most people find genuinely surprising. Professional money managers, the people who get paid millions to pick stocks, almost universally lose to a simple index fund over long periods. Studies tracking this over decades consistently find that the vast majority of actively managed funds underperform a simple index fund over 15, 20, 30 years. 3 reasons why. 1. Fees. Active funds charge much higher fees than index funds, sometimes 10 or 20 times higher. Those fees eat returns every single year. 2. Picking winners is hard. Even professionals with teams of analysts get it wrong more often than they get it right. The market is full of smart people. Beating them consistently is rare. 3. Compounding. Small differences in returns each year, multiplied across decades, become enormous gaps in the end. The boring answer wins because boring is built for the long game. You're not trying to be smart. You're trying to be patient. Okay, how do you actually pick one? Walk into your brokerage's website. There will be hundreds of options. This is where beginners freeze. Don't. Use 3 simple filters. Filter 1, broad. You want a fund that holds lots of different companies, ideally across the whole stock market or a major chunk of it. Look for words like total market, broad market, or one that tracks a major index of the largest 500 companies. Filter 2, cheap. Look at something called the expense ratio. It's the annual fee. For a good index fund, this should be very low, typically well under 0.1%. If a fund's expense ratio is 1% or higher, it's not the kind of fund you want. Filter 3, boring. The fund should aim to match a market index, not beat it. If the description uses words like actively managed, high growth strategy, or thematic, that's not what we want. We want plain vanilla. Boring is the goal. Any fund that passes all three filters is good enough. You don't need the perfect one. You need a good one, bought consistently for 30 years. One more thing that confuses beginners. You'll see two versions of similar index funds, one labeled ETF, one labeled mutual fund. For your purposes, they do almost the same thing. Both hold the same underlying mix of companies. Both grow the same way over time. The differences are small. ETFs trade throughout the day like a stock. Mutual funds only update once per day after the market closes. ETFs sometimes have slightly lower fees. Mutual funds sometimes have minimum investment requirements. For most beginners, pick whichever your brokerage makes easier. Both are perfectly fine choices. This is not the decision that will make or break your retirement. Don't let the twin labels paralyze you. The difference between two good index funds is microscopic compared to the difference between investing and not investing. Now, the habit I promised at the start. The one that quietly erases years of returns, even from smart investors. Selling when the market drops. This is the single most expensive thing most retail investors ever do. The market will drop. Sometimes 10%. Sometimes 30%. Occasionally 50%. It has done this many times. It will do it again. That is not a sign the strategy is broken, that is the strategy working as expected. The historical returns of index funds, the ones that turn $50 a week into wealth, only happen for people who stayed invested through those drops. People who sold during the dips and bought back later almost always ended up with less. The recipe is simple. Buy a boring index fund. Set up automatic monthly contributions. Then, and this is the hard part, do nothing. Do nothing during the headlines. Do nothing during the panic. Do nothing during the recoveries. The fund manages itself. Your job is to not interfere. Investing isn't an action. It's a habit of not acting. That's the recipe. An index fund is a tiny slice of thousands of companies, bundled into one purchase. It works because it's cheap, broad, and patient. Pick one using three filters: broad, cheap, boring. ETF or mutual fund, either works. Then automate it and don't sell when things look scary. You now have the complete picture. The budget. The emergency fund. The Roth IRA. The index fund inside it. That's the entire foundation of a healthy financial life. Fewer than 10 ingredients, no jargon, no finance nonsense. If this series has been useful, subscribe. Every week I drop one new recipe for handling money without losing your mind. Next week we're tackling the topic everyone gets emotional about: paying off debt, and the smart way to decide what to pay first. Until then, keep the kitchen open.